Welcome to the deep dive. Today, we're really digging into the current outlook for investing in emerging markets. We'll be focusing particularly on equities and debt.
And our guide for this exploration is, well, it's the latest analysis from the folks over at JP Morgan.
Exactly. So the goal here is to pull out the key takeaways from these reports. We want to answer that big question. With all the shifts happening in the global economy, trade dynamics, where are the real opportunities?
And maybe where are the pitfalls, the risks in emerging markets right now? And importantly, what does all this actually mean for you, trying to make sense of the global investment picture?
Yeah, absolutely. We've got quite a bit of material to unpack here, everything from trade deals to currency movements.
Yeah.
Okay, so let's jump in. Something that really stood out to me first off. JP Morgan has actually upgraded emerging market equities. They've moved from neutral to overweight. That feels like a pretty big call.
It is a significant shift, yeah. And their reasoning seems to hinge on a couple of really key factors they're seeing play out. The first one is this noticeable easing, a de-escalation, you could say, in trade tensions, specifically between the U.S. and China.
Right.
Their analysis points directly to the recent tariff cuts as a major driver for this more positive stance.
Right. Those were quite substantial cuts, weren't they? The U.S. bringing tariffs on Chinese goods down from, was it 145% to 30%?
Yeah, and China responding, cutting tariffs on U.S. goods from 125% down to 10%. I mean, those aren't small adjustments.
Definitely not.
Oh.
So what's the expected impact? What kind of knock-on effects are they seeing from these changes?
Well, the core idea is pretty straightforward. Lowering these barriers, it basically removes a major headwind that's been kind of weighing down emerging markets for a while.
Okay.
Making trade cheaper, less complicated. Well, the thinking is that should give a nice boost to global trade flows and perhaps more importantly, encourage more investment directly into these emerging economies. It's sort of like the wind resistance just dropped off suddenly.
Yeah, that makes sense. Less friction, things move more easily.
Yeah.
And I guess this isn't just a blanket positive view across all emerging markets, is it? Does the report highlight specific areas?
Oh, absolutely. They don't paint everything with the same brush. They point to a really interesting, quite diverse group of markets that look particularly promising right now.
Like who?
We're talking India, Brazil, the Philippines, Chile, the UAE, Greece, and Poland. So quite a geographical spread.
Wow.
It suggests, different regional strengths are kind of coming to the fore. India, for instance, with its strong domestic story and reforms, that looks quite attractive in this setup, according to them.
Interesting. And within that wider view, I think they zoomed in on one particular sector, China's tech sector.
Yes, they did. That's an area they specifically flag as offering an attractive investment opportunity right now.
Why?
Well, it seems they're seeing a combination of things, a rebound in spending in some tech areas, and maybe, just maybe, a slightly more accommodating regulatory environment from Beijing lately. It suggests a potential turning point, perhaps.
Okay, but we should probably temper that slightly. I mean, things can change quickly, right?
Yeah.
The report does mention trade tensions could flare up again.
Of course, yeah. You have to acknowledge that risk. It's always there. But the general feeling, the sort of baseline assumption in the report, seems to be that the worst of the disputes and the market volatility tied to that might be behind us now.
So a more stable footing, potentially.
That seems to be the core message, yeah. A more stable backdrop for investors compared to, say, the last few years. And, we might already be seeing some signs of this renewed confidence starting to filter through.
You mean in the market performance?
Exactly. Look at the MSCI Emerging Markets Index. It's already up about 9% this year, 2025. That does suggest investors are, well, starting to put money back to work in this space.
That's a decent start to the year. But it's also worth remembering the longer-term context, isn't it? Emerging markets have actually struggled quite a bit relative to developed markets recently.
That's a really crucial point. Since 2021, EM has lagged DM by, I think the number was around 40%, a huge gap.
Wow.
So that underperformance is actually part of why this upgrade feels significant. It hints at the potential for these markets to maybe start closing that gap.
And does valuation play into this as well? How are these assets priced currently?
Yes. Valuation is key here. There's a pretty stark difference when you look at the price-to-earnings ratios. And just quickly for our listeners, a lower PE generally means you're paying less for each dollar of earnings, potentially better value.
Right.
So the forward PE in emerging markets is sitting around 12.4. Compare that to developed markets where it's much higher, up at 19.1.
Big difference.
Yeah, that gap really highlights how much more affordable, relatively speaking, EM equities look right now.
Okay, so we've got easing trade tensions, we've got attractive valuations, and then there's the other big piece, the U.S. dollar. It's been weakening. How does that fit into the picture?
Right. The weaker dollar is another significant positive factor here. Generally, a falling dollar acts like a tailwind for emerging markets.
Oh, so.
Well, it makes their assets cheaper for international buyers, for one, and it can also ease the burden for countries and companies that have borrowed in dollars.
Makes sense.
And JP Morgan actually expects the dollar to weaken further in the second half of the year. They see this as another potential catalyst, something that could speed up foreign investment flowing into EM and help push up equity prices.
And it has fallen quite a bit already this year, hasn't it? The dollar index is down, what, about 7.5% in 2025 so far?
Around that, yeah. And the reasoning behind expecting more weakness, the report points to growing worries about U.S. economic policy, stability, predictability, that kind of thing.
So uncertainty in the U.S. pushes investors to look elsewhere.
That seems to be the thinking. Less appeal for the dollar as a safe haven, maybe. Encouraging investors to seek opportunities where the growth story might look, comparatively stronger, like in some emerging markets.
Okay, that lays out a compelling case, or at least a more optimistic one, for EM equities. Let's switch gears a bit. What about emerging market debt? What are the main themes JP Morgan sees there for, say, Q2 2025?
Right. So moving on to the debt side, it's maybe a little more complex. Several key themes emerge from their analysis.
Okay.
One they talk about is this idea of a growth leadership rotation. Basically, even if the global picture is a bit messy, fundamentally strong emerging markets, the resilient ones are still expected to do well.
So it's not about the whole asset class moving together, but picking the right spots.
Exactly. Selectivity seems key. They also really highlight the attractive real rates you can get in EM local currency debt.
Real rates being the return after inflation.
Precisely. And those look quite high in many EMs right now. So because of this, their strategy seems to favor focusing on specific strong opportunities, what they call idiosyncratic opportunities, rather
Yeah.
than just buying the whole market.
A more targeted approach, then. What about hard currency debt? Bonds issued in dollars, for example.
Yeah, so for hard currency sovereign and corporate credit, they mention a preference for something called front-end carry in quality high-yield names.
Okay, break that down a bit. Front-end carry.
Sure. It basically means they like shorter-term bonds from issuers, countries, or companies that are rated BB, so still high yield.
Yeah.
But, and this is the key part, they have a good chance of being upgraded to investment grade soon.
So you get a decent yield now, plus potential upside if the rating improves.
That's the idea. They actually give examples like Paraguay, Oman, Guatemala, places where they see this potential. You get paid reasonably well while you wait without taking on super long-term risk, and you might get that ratings kicker.
Interesting strategy. Okay,
Yeah.
and what about currencies? EMFX. Their view seems to be shifting there, too.
Yes, they're becoming increasingly bullish, is the word they use, on EM foreign exchange overall.
But selective again, I assume?
Very selective. They particularly like what they call EUR-based resurgence trades. So currencies linked somehow to a potential Eurozone recovery. They also favor higher quality currencies in Asia and emerging Europe.
And we're less keen on others.
They're more cautious, maybe more tactical with what they term high beta currencies. Those are the ones that tend to swing around more with global risk sentiment. And they're also being quite selective in Latin America, mainly due to uncertainty around where commodity prices are headed.
Right, commodity prices are always a big factor there. Okay, so that's the opportunity side. But no investment comes without risk. What are the main potential downsides JP Morgan is watching?
Yeah, they flag a few key risks, definitely. Number one, probably no surprise, is the potential for tariffs and trade uncertainty to return, especially linked to possible U.S. policy shifts down the line.
Always a possibility.
What else? Second, any unexpected changes from the U.S. Federal Reserve. If they suddenly signal a more aggressive path, or if U.S. financial conditions tighten significantly, that could cause problems.
Okay, Fed policy.
And third, the price of oil. Always a big one for many emerging economies, both importers and exporters. So those are the main ones they're keeping a close eye on.
Standard watch list items, really, for global investors.
Hmm?
But if we step back from the risks for a moment, the overall tone from JP Morgan does seem, well, cautiously optimistic.
Mm.
What are the deeper economic fundamentals supporting this view?
That's a good question. A really crucial factor is just the underlying economic strength in many EMs. They point out that if you exclude China versus the U.S., emerging markets still maintain a healthy growth advantage over developed markets.
A growth differential.
Exactly. And that differential is actually expected to get a bit wider in the second half of 2025, maybe reaching 1.1 to 1.3%. So the core growth story remains intact, even with China moderating a bit. And connected to that, they talk about the fading of U.S. exceptionalism. You know, the idea that the U.S. economy was outperforming everyone else significantly.
Right.
With the U.S. slowing down a bit now and maybe more policy uncertainty there, the contrast isn't as sharp. Plus, you have potential positives elsewhere, like EU stimulus potentially helping emerging Europe.
And what about China's situation specifically? They mentioned the slowdown.
Yeah, China's growth has moderated, mostly because net exports have decreased. But the key thing is the government's response. They seem to be actively pivoting towards using fiscal policy, government spending, and support to boost domestic demand, trying to offset those tariff headwinds internally.
So policy support is a factor. And are EM countries generally in better shape financially these days? Fiscal health.
That's another really important point they make. Many EM countries have actually been quite disciplined fiscally. They've been consolidating their budgets, keeping public debt manageable. And you can see this reflected in credit ratings. In 2024, there were actually more rating upgrades than downgrades for EM sovereigns. And they expect that trend to largely continue this year. It points to improving fundamental strength.
And for the debt investors, those high real yields you mentioned earlier must be a big draw.
Oh, absolutely. Real yields in EM local currency are, as they say, at decade highs. That's because inflation has come down quite a bit in many places, while EM central banks were quite proactive in hiking rates earlier.
So it creates a buffer.
Sort of. It gives them options. If the global economy has a soft landing, investors get those nice high real yields. If things turn worse, the central banks have room to cut rates to support growth. It's a relatively attractive position either way.
And does this feed back into the equity story? This idea of investors looking beyond the US dollar?
It definitely connects. This growing interest in non-USD assets among equity investors lines up perfectly with the more positive outlook for EM currencies.
Because the dollar might be overvalued.
That's part of the argument, yeah. Dollar seen as potentially stretched, U.S. economy slowing, U.S. rates might fall. All that could lead to capital flowing out of the U.S. and looking for a home elsewhere, including EM, supporting EM currencies and assets.
Got it. Okay, one last area, tariffs.
Yeah.
You mentioned the risk, but the report also added some nuance, didn't it? It's not a uniform threat.
Right, exactly. It's not a simple story. While tariffs are a risk factor overall, J.P. Morgan argues that the biggest threat comes from potential reciprocal tariffs hitting specific countries.
Which ones did they mention?
They flagged India, Argentina, and Indonesia as potentially more exposed if we saw another round of tit-for-tat tariffs.
Cool.
But they also make the point that many EMs already operate with higher tariff levels than developed markets. And often, the countries with the very highest tariffs are larger economies that are more focused inward on domestic demand. So they might be less impacted by new global trade barriers than you'd initially think. It's complicated.
Definitely sounds like a complex picture. Okay, so if we try to sort of synthesize all this, bring it together, the J.P. Morgan view seems to be that emerging markets, both equities and debt, are looking, well, more compelling right now.
I think that's a fair summary, yeah. You've got this convergence of potentially positive factors, easing trade tensions, the weaker dollar, valuations that look pretty attractive, and, importantly, resilient underlying economic fundamentals in many of these countries.
And we heard about specific bright spots, India, Brazil, China tech, certain types of high-yield debt, select currencies.
Exactly. Lots of specific areas highlighted. But,
Yeah.
we also have to stress the caveats.
Always. The risks remain. Trade policy uncertainty, what the Fed does, commodity price swings, those are all still very much in play.
Absolutely. You can't ignore those. But overall, the narrative, the momentum, it does seem to be shifting, maybe tilting a bit more favorably towards emerging markets after a tough few years.
Okay. So maybe a final thought to leave our listeners with, something to chew on.
Yeah, perhaps this. Considering everything we've just discussed, the trade shifts, the dollar, the valuations, the fundamentals, and thinking even longer term, how might these ongoing shifts in the sort of global economic balance of power continue to shape where the opportunities lie? How might it influence your investment strategy in emerging markets down the road?
Hmm, that's a big question. Definitely something to keep thinking about. It's a dynamic space, that's for sure.